Grant's Interest Rate Observer founder, Jim Grant, is with us right now to talk more about that. Jim, good to see you.
Hey, Maria.
Thank you so much for joining us. First, kick us off with your characterization of where we are in terms of the backdrop. You know, we're talking about whether or not rates are going to go higher in June, September, October, and yet the economy sort of just bumps along the bottom in some ways.
Yes,
How do you characterize it?
I think the economy is slogging along. You know, there are any number of ways to look at things, but it seems to me that we are more or less sleepwalking. Certainly there's nothing like zest, nothing like the dynamism that one is so often associated with the America's economy.
So then, in that regard, do you expect rates to go higher?
No,
I mean,
I do not.
You do not.
I expect that the Federal Reserve will not act. I think that the Fed, wants to. I think it would love to normalize things, but I think it has missed its chance. As they say on Wall Street, it missed its market.
So this year, no rate hike?
I don't think so. I don't want to dogmatize too much. My opinion is no rate hike this
year. John,
Jim, you spent a lot of time looking for distortions in markets, particularly distortions caused by low rates. What are you seeing out there that worries you right now?
Well, I think there's kind of bubbling trouble in credit. I think what we see is that people have stretched and strained to consume as they had been accustomed to doing, and that the trouble with stretching and straining without adequate income is that you go into debt, and we see a lot of emerging debt troubles throughout the wholesale and retail economy.
Well, where in the retail? You're talking about not credit cards, car loans in particular?
Yeah, subprime auto loans, for example, is one glaring example, and there are others. The trouble with one of the troubles with ultra low rates is they do two things. They accelerate consumption. They bring it forward in time, and also they defer problems, because companies that with a normal rate structure would be denied access to credit are able to borrow, and thereby to perpetuate corporate lives that might well, in a more dynamic economy, be ended, and thereby leaving space for newcomers. So what we think is that the consumption will continue to weaken owing to the burden of debt, and that bankruptcies, having been postponed through ultra low and abnormally low rates, will be piling up in the near future.
So what do you think comes out of these? You know, we got Janet Yellen speaking this Friday. We got her back again on Monday with another speech, and then of course the Fed meeting on June 15th. What should we be focused on coming out of the Federal Reserve? Their characterization of where we are, or what specific metrics do you look at?
Well, one thing I've noticed, to my relief and amusement, is something that came out of one of the regional Federal Reserve banks. John, which one was it who said the Fed might consider just shutting up for a while?
Yeah, right.
My friend Seth Lipsky, and it's the New York Sun, calls this the verbal dollar. Money talks, the Fed talks and talks and talks.
Yeah.
It will not be quiet. So we listened to this and that regional Fed president saying, oh yes, things are looking very, very good. We think we'll move in June. And the other one says, well, perhaps, and yet perhaps not. And finally, it comes to the chair herself, who has the power. And so we await her word. But isn't this a market economy? And aren't interest rates prices? And ought not prices to be discovered rather than administered? Yeah. I mean, this is the great question. I wish the Wall Street Journal, John, would take this up.
Well, I mean,
well, wait a second. Just to speak to what you were just saying, San Francisco Federal Reserve President John Williams joined me on Sunday. And he basically said the U.S. economy is booming. Listen to this, his answer when I asked him if, in fact, we're going to go into recession in 2017.
First of all, economists are just not good at forecasting recessions a year off in the future. I see the fundamentals as very solid. I see growth continuing to be good. And, you know, at the Fed, we're going to be trying to get this very smooth landing, bring the plane exactly onto the runway the best we can. So I expect growth to be around 2%. I think the risks of recession are pretty modest.
Do you think we're going to see a recession in 2017 or 18?
I guess. I mean, this is an ultra-long business expansion, as lethargic as it has been. It has been a very long-lived one.
So at some point,
when they say that these expansions don't die of old age, but to a degree they do, because of the distortions introduced, among other things.
What's going to cause the 2017 recession?
Oh, I mean, too many sellers, not enough buyers. I don't know, John, but Typically, it's a lack of enterprise, lack of profitability, excesses in debt, shocks from, from stage left or stage right, not scripted.
Jim, what do you make of these negative interest rates? I mean, negative interest rates in Japan obviously have not.
On them.
You're negative on negative interest rates.
I mean, I think they're an arithmetic absurdity, and I think that they are the manifestation of the conceits of the PhD standard of monetary management. We have 700 economists, PhD economists in the Fed. They think up things like negative rates, not just ours, but the ECB's and the Bank of Japan's economists. And as my friend Jeff Goodluck says, we have 700 PhDs, and we either need 701 or many fewer because it's not working. So I think that
well, it's the equivalent of you're in a room with 700 people who always agree with you, and you ask them, hey, is this pimple noticeable? And they go, no, it looks fine. And to the outside world, it's hideous.
Well, there's a bunch of Democrats who...
I'd never heard that analogy.
I'm serious, though. It's like they all agree with each other because it's
Democrats petitioned, dozens of them petitioned the Fed, I think, last week for more diversity within the Fed. And they meant...
diversity of thought, you mean?
No, they meant diversity of race and gender and the like. But skin-deep diversity is no good. What we want are people who think differently.
Right.
And the general dynamic stochastic general equilibrium model. I'm bungling that. But the intellectual framework by which the Fed directs our monetary fortunes has been shown to be ineffective at anticipating the future, which they say they're in business to do.
They blew it in 15.
On one point about administered rates. It is true that the Fed manages the federal funds rate, and that influences other rates. But, I mean, as you know better than anyone, the market trades on spreads, right? So the market determines the rates on credit cards and auto loans and mortgage debt.
Exactly, John. They trade on spreads. When the basic wholesale rate is 0 or thereabouts, the spreads are necessarily narrow. And we have been in a 35-year or so bull market in bonds, meaning interest rates have fallen for the length of entire Wall Street careers. And this is muscle memory. People project the recent past into the indefinite future. So I think the Fed does more than influence. It is a powerful force, I think, for distortion.
A number of the candidates said that they're going to not renew or reappoint Janet Yellen. Is that a smart move?
I don't think Janet Yellen, the person, is the problem. I think Janet Yellen, the type, is the problem. I think Janet Yellen... John, you had the most fabulous scoop, which you buried, I think, the 4th or 5th paragraph 4 or 5 months ago, which was that Janet Yellen, when she goes to the airport for a flight, arrives hours, plural, early. This woman is a very, very cautious and punctilious person, but she... Apart from Janet, what she represents is the triumph of the professional economist managing central banking affairs. Now, in the 50s, they had few, if any, and it wasn't such a bad decade.